The numbers are in, and frankly, they paint a rather troubling picture. Global mineral exploration, the very lifeblood of the mining industry, is facing a significant downturn in 2024. Budgets have tightened across the board, dropping by a worrying 11% to just over $11 billion this year. Now, that might sound like a lot of money, but in the grand scheme of things, it reveals a deep-seated caution gripping the industry. This isn't just a minor dip, it's a signal of a much larger trend. Companies are pulling back, they're hesitant, and they are re-evaluating where every single dollar is spent. The optimism of previous years has clearly faded. What is most alarming, however, is not just the overall drop, but where the cuts are deepest. I'm talking about early stage, or what the industry calls grassroots exploration. This is the riskiest, most adventurous part of the business. It's about heading into the unknown, drilling in new territories, and hunting for the giant discoveries that will power our future. In 2024, the budget share for this vital activity has plummeted to a record low of just 24%. Let me be clear, that is the lowest proportion we have seen in over 2 decades. This tells us that the appetite for risk, for true discovery, is at an all-time low. This trend is not happening in a vacuum. It is a direct response to the turbulent global economy we find ourselves in today, on June 12, 2025. Inflation remains a persistent headache, interest rates are high, and geopolitical instability adds another layer of uncertainty. Metal prices, which are the ultimate driver of exploration spending, have been volatile. While some metals like copper have seen strong periods, the overall basket of commodities has not provided the sustained high prices needed to encourage bold, speculative investment. It's a classic case of risk aversion in uncertain times. The implications of this retreat from grassroots exploration are profound. Think of it like this. If you stop planting seeds, you can't expect a harvest later. These early-stage projects are the seeds of future mines. Without them, the pipeline of new mineral deposits will begin to dry up. This isn't a problem that will bite us tomorrow or the next day, but it is a long-term crisis in the making. We are, in effect, borrowing from the future to manage the anxieties of the present. And that, as any good business person knows, is a very risky strategy indeed. So if the money isn't flowing into new discoveries, where is it going? The data reveals a clear and telling shift in priorities. While early-stage exploration budgets have been slashed, and even late-stage project evaluations are seeing less funding, there is one area that has held up relatively well: minesite exploration. This is the work done around existing mines, looking to expand known ore bodies or find satellite deposits nearby. Its budget share has actually increased to a record high of 43%. This is a fundamental change in strategy for the entire industry. Let's break down the numbers a bit further. The budgets for both early-stage and late-stage exploration, the entire pipeline for finding and defining new mines, are down significantly. This means less money for initial reconnaissance and less money for the detailed drilling required to confirm if a discovery is economically viable. Companies are essentially saying they don't have the confidence or the capital to shepherd new projects from A to Z. Instead, they are pouring their limited resources into what they already have, trying to squeeze more out of their existing assets. This shift is visible across different resource types. While the hunt for gold continues to dominate exploration budgets, accounting for nearly half of the global total, even its funding is down. The budgets for critical minerals, the very metals needed for batteries, electric vehicles, and wind turbines, have also taken a hit. This is particularly concerning. At a time when the world is screaming for more lithium, cobalt, and copper to fuel the green energy transition, the industry tasked with finding them is becoming more conservative and less adventurous. Ultimately, this reallocation of capital is a story of caution over courage. It reflects a mining industry that is battening down the hatches. Rather than sailing into uncharted waters in search of treasure, companies are choosing to dredge the familiar harbours they know well. It's a lower risk, lower reward strategy. While it may offer some financial stability in the short term, it fails to address the much larger looming question of where the next generation of world-class mines will come from. The industry is playing defence when it desperately needs to be playing offence. The reason for this strategic pivot is quite simple. Risk and reward. Investing in grassroots exploration is a high-stakes gamble. The odds of finding a commercially viable mineral deposit are incredibly low. Some say less than 1 in 1,000. It requires immense patience and deep pockets, with no guarantee of a return for years, if ever. In today's economic climate, shareholders and investors are demanding more immediate returns and financial discipline. They have little appetite for long-shot bets, and so the major mining companies are listening and redirecting their capital accordingly. Expanding an existing mine is, by comparison, a much safer bet. The geology is already well understood, the infrastructure is in place, and the permitting process is often simpler. You have a workforce, a processing plant, and established relationships with local communities and governments. Adding a few more years to a mine's life by expanding its known reserves is a far more predictable and financially attractive proposition than starting from scratch in a remote, unexplored region. It makes perfect sense from a quarterly earnings report perspective. This trend is being driven by both the giants of the industry and the smaller junior explorers. The major mining companies, which have the largest budgets, are increasingly focusing their efforts on their own mine sites or acquiring advanced projects from smaller firms, rather than funding early-stage exploration themselves. At the same time, junior exploration companies, which historically have been the engine of discovery, are struggling to raise capital. Investors are wary, making it incredibly difficult for these small, nimble outfits to get the funding they need to go out and drill. This creates a dangerous feedback loop. The majors won't fund risky exploration, and the juniors who are willing to take those risks can't find the money. The result is a hollowing out of the discovery pipeline. The industry is becoming more concentrated on existing assets, creating a system that is incredibly efficient at exploiting what is already known, but increasingly poor at finding what is new. This focus on short-term safety and predictable returns is directly undermining the industry's long-term sustainability. It is a classic case of prioritizing today's profits over tomorrow's prosperity. The consequences of this prolonged drought in discovery are stark and unavoidable. The most immediate impact is a simple one. Fewer major mineral discoveries are being made. The pipeline is not just thinning, it's beginning to run dry. The giant world-class deposits that are easy to find near the surface have, for the most part, been found. Future discoveries will likely be deeper, in more remote locations, and will require more sophisticated, expensive, and risky exploration techniques. By underfunding the search now, we are delaying and jeopardizing our ability to find them. This creates a serious challenge for future mineral supply. Mines are finite resources. They eventually run out of ore and close. To maintain a steady supply of metals for the global economy, the rate of new discoveries must keep pace with the rate of depletion. Right now, that is not happening. We are consuming our known mineral reserves faster than we are replacing them with new ones. This sets the stage for future supply shortages, price volatility, and increased geopolitical competition for the resources that remain. It is a slow-moving crisis, but one that is gathering momentum. The stakes are even higher when you consider the green energy transition. The shift to a low-carbon economy is incredibly mineral-intensive. An electric vehicle requires 6 times more minerals than a conventional car. An offshore wind plant needs 13 times more mineral resources than a similarly sized gas-fired plant. We need staggering amounts of copper, lithium, nickel, and cobalt. Yet, at the precise moment that demand is set to explode, the industry is pulling back from the very exploration needed to find these essential metals. This is a fundamental contradiction that we have yet to resolve. In conclusion, the mining industry finds itself at a critical crossroads. The current strategy of focusing on safe mine site expansion while neglecting grassroots exploration is a logical response to economic uncertainty, but it is not a sustainable one. To secure the resources needed for a prosperous and green future, we must find a way to encourage and fund a new era of discovery. It requires a difficult balance between managing short-term risk and investing in long-term resilience. Without a renewed commitment to bold exploration, the ticking clock on our mineral supply will only get louder. And that, frankly, is bad for business.